There are only three fundamental worldviews when it comes to investing. Until you know which one you are, you'll constantly get in your own way as an investor. I'm Bryan Ellis. I'll help you figure out which one you are and help you to be the best of who you can be as an investor, right now in episode number 105.
You're listening to Self-Directed Investor Radio, America's only podcast exclusively for affluent, self-directed investors, where each day of the week you receive innovative investment strategy and deadly accurate market analysis that's untainted by Wall Street and unblemished by government propaganda, all in 7 minutes or less. Coming to you now from iTunes, Stitcher, and SDIRadio.com, here's your host, Bryan Ellis.
Welcome, my friends, to another excursion into investment excellence. Folks, we all love a good self-assessment. Who among us hasn't taken a personality test just so we could read about ourselves, or maybe an IQ or aptitude test just to see how smart or gifted we really are? So let's pull back the curtain in your brain to see where you stand as an investor. There are really only three basic investment worldviews: the trend follower, the contrarian, and what I'll call the infrastructurist. You're quite certainly more one of these than the other two. In other words, you have a single dominant approach, but all three are completely valid. Which are you? Let's figure it out. Investing worldview number one is the trend follower. This type of investor looks for the asset that's already profitable and buys in under the assumption that success breeds more success. This is the investor who right now would buy Apple stock because it's done so well for so long. This investor would right now buy into real estate in San Francisco because it's a super hot market. The trend follower is not a value investor. You've heard the phrase buy low, sell high? The trend follower doesn't do that at all. The trend follower buys high and hopes to sell higher. Investing worldview number two is the contrarian. The contrarian believes that nothing is forever and everything operates in cycles. As such, he looks for assets that are about to switch direction in value so he can capitalize on being in front of trends before they happen. The contrarian profits by jumping into an asset before it's popular and taking advantage of the wave as the out-of-vogue asset becomes cool again. This is the very essence of the buy low, sell high approach. Now, most investment experts end the discussion with trend followers and contrarians, but I know there's a third investing worldview, which I call the infrastructurist. What is infrastructure? It's the basic structural stuff needed to make an organization or enterprise function correctly. In the context of a country, it's things like roads, bridges, power plants, etc. But in the context of business, infrastructure is really just one thing: capital. And the infrastructurist deals in capital rather than in the things capital can buy. A simple generalization is that the infrastructurist is usually focused on collateralized debt investments, lending in other words, rather than equity investments. If you'd rather make loans to the person buying real estate in San Francisco rather than buying the property yourself, you're an infrastructurist. If you'd rather buy bonds issued by a company rather than their stocks, you're an infrastructurist. There's absolute merit to each one of these approaches. The key for you, my friends, is to figure out which one you truly are. Investment strategies that appeal to the trend follower will likely be anathema to the infrastructurist, for example. But here's the big idea I want you to take home with you from this discussion. Most investors believe themselves to be trend followers because that's what's publicized as the right way to invest. Everybody sees what's happening with Apple stock over the last several years. We all see what's happened in San Francisco real estate, and those things look appealing. And frankly, following the crowd is what we're all taught to do. Maybe that approach matches who you really are, but my friends, you and I are not sheeple, we're people. You're not just an investor, you're a self-directed investor, and that distinction is truly important. What that means is that you make your own investment decisions independently, your own criteria, your own objectives, your own values. You inherently don't follow the crowd. Doesn't mean you won't buy Apple stock or San Francisco real estate. It just means you don't trust Wall Street, the media, social pressure, or even your financial advisor to make your investment decisions for you. You understand at a core level that nobody cares as much about your portfolio as you do. There's one core value of wise, self-directed investors, and it is this: we self-directed investors respect our own capital. That capital came as a result of your own toil and trouble, or through the blood, sweat, and tears of someone who cares about you. It deserves your respect. But without a clear success plan, the notion of respecting your own capital is just a platitude. So the way that wise self-directed investors like you and me actually implement the core value of respect for capital is through the consistent application of the S3 criteria. The S3 criteria demands that we evaluate and constantly reevaluate our investment choices by these standards. Number one, simple. Is the investment understandable? Can it be summarized clearly in a statement of 30 seconds or less such that your grandmother would think it's a wise choice? Remember, complexity hides risk. Risk is your enemy. Standard number two, safety. You know what you expect your investment to do for you financially, but what if you're wrong and it goes totally against you? Is there a plan B that protects your principal? Rule number 1 of successful investing is never lose money. Standard number 3, strong. Will the asset you're evaluating generate a return that's strong enough to meet your objectives when the time comes to exit that investment? And just as importantly, will your investment maintain value and avoid volatility during its life cycle? Volatility is inconsistency. Inconsistency creates stress and indicates weakness. Weakness leads to loss. Never lose money. Simple, safe, strong. That's the S3 criteria. Every investment you take as a self-directed investor must be all 3 of those things. And you know what? It's absolutely possible to successfully apply the S3 criteria regardless of whether you're a trend follower, a contrarian, or an infrastructurist. But my friends, I respectfully suggest to you this notion. If you're primarily a trend follower, as is the case for nearly everyone who invests primarily in Wall Street stocks, think really hard about whether that is who you really are. Because I submit to you that the fact you're listening to this show suggests you may actually be more of an infrastructurist than anything else. Why? The infrastructurist deals in capital. As an infrastructurist, your basic tool is the loan. Now, loans are a dull and boring concept, but they have some real advantages as an investment. They can be structured so that they can be profoundly safe. They can be structured so that their ROI is overwhelmingly attractive. They can be structured as attractive investments to third parties, bringing great liquidity opportunities. And the words "they can be structured" implies one central concept: control. The infrastructurist demands control of his or her capital. And with that control comes the opportunity to invest exclusively in opportunities that you have structured to be simple, safe, and strong. But for you trend followers, where do you think the real estate market is headed? My gut tells me that we're due for some cooling and maybe reversal. But one really accurate market indicator gives a totally shocking clue that, frankly, every one of you need to know about. I'll be interviewing a fascinating market analyst about this prediction next week, and this is it's genuinely fascinating stuff, shocking stuff, actually. You absolutely need to hear it. This is longer than I can put on this show, but if you're a member of my 5-star listener group, you'll get it for free. And you can join the 5-star listener group at absolutely no cost. Just text the word SDI Radio to 33444 right away, and I'll give you instructions on how you can join for free. Again, just text the word SDI Radio with no spaces or periods to 33444 right now, and I'll give you instructions for becoming a member of the 5-star listener group right away so you can hear next week's interview, along with some other fascinating content that's already posted in that group. My friends, invest wisely today and live well forever.
Thank you for listening to Self-Directed Investor Radio with Bryan Ellis. Don't miss a single episode. Be sure to subscribe to Self-Directed Investor Radio right now on iTunes, on Stitcher, and at sdiradio.com. Your feedback is always welcomed via email at feedback@sdiradio.com. This show is for entertainment purposes only and is not intended as legal or professional advice for your situation. Content is the property of the Self-Directed Investor Society.